without further ado, I'll pass over to you to present.
Thanks, James. So good evening, everyone. Thanks for sticking around for the final presentation. So I'm Stephen Williams, this is Sachin Oza, and we're the recently appointed co-CEOs of Reabold Resources. We joined the company officially about 6-7 weeks ago when we raised £6 million, or just under £6 million, to launch a new strategy for the company, which we will take you through now. I'm going to start by just talking about that phrase in the heading, which is that we do things differently. Now, you hear that a lot, so I'll explain what I mean by that in our case specifically. And this really relates, I think, to our background. So we have somewhat atypical backgrounds as junior oil company management team, in that we come from the investment community. So we've been investment professionals for pretty much the entirety of our careers, most notably at M&G Investments. We covered the whole spectrum of the energy industry, but we had a particular interest in pre-cash flow assets and in junior upstream oil and gas companies. Now, we lived through a pretty extensive period where something quite strange was happening for us as investors, which meant that even when we got the asset right, so we found the right quality asset with a good management team, we were still finding that share price performance was impossible to come by. And there was nothing more frustrating than having your expertise in a sector where no matter what you did, no matter what asset you picked, you wouldn't put money into it because you thought the share price was going to fall by 80 to 90%. Wasn't a very comfortable position to be in. So when we joined Reabold and we put together the strategy for Reabold, we had one thing in mind really, which was how to close that gap between high quality assets, which we will talk you through the assets and we believe they're very high quality, and share price performance. So everything that we do, from the top level strategy right down to the way we run the business day to day, is designed to make sure that shareholders see a positive return. So we're not necessarily thinking about building the next great oil company. What we want to do is create value for our shareholders. Now, we're going to invest in, and we are investing in, low risk from a technical perspective and low capital requirement projects, because capital is still scarce in the industry, but that deliver very high impactful returns for our company and for our shareholders, and that have very near-term catalysts. It's worth noting as well, we think this is the ideal time to be putting money into the sector generally, and in particular to be putting money into the ground. So if you do any analysis of the history of the oil and gas industry, what you'll find is that positive returns are only generated when costs are low. Capital has to be invested when costs are low. The commodity price will sort itself out over time. The money that's invested counter-cyclically when costs are low generates positive returns, and that's exactly the situation that the industry is in at the moment. And then finally, I sort of mentioned we're kind of catalyst rich, but our capital specifically will drive activity in the projects in which we invest in. So I won't dwell on this is just us, and the point I've already made that our background is from the investment community. I will mention that the other member of our team, which is Peter Dolan, he's on board as an advisor. He's a genuinely legendary figure in this pre-cash flow part of the oil and gas space, geologist of some merit for many decades, most notably the founder of Afia Energy, and we're delighted to have him on board with us. Okay, so we've got this S-curve of value creation here, and we've always found that you get the most bang for your buck and over the most compressed time frame. In the middle part, the steep part of that curve, which is really somewhere between around about the initial resource discovery in a new play and the point at which you get a fully defined development project, because that's when the market can start to efficiently value the project. Now, what we found over the last few years, though, is there are a number of fairly good quality companies with very good quality assets who have progressed those assets towards the right-hand side of that chart. They've done the work to unlock the value, but they've not seen any appreciation in the value of the project, either in industry terms or particularly in financial market terms. And in many cases, they are just one step away from properly unlocking the inherent value in those projects. So they sit where that red dot is now. So what we've essentially seen for a number of projects is a real steepening of what was already the steep part of the value creation curve, and that's where we plan to invest. And our capital unlocks the delta between the red dot and the top of that black line. So we think that more than any other time, this is the time in which you can really generate the most meaningful returns for your capital if it's put into the ground in the right assets today. Okay, so how do we go about picking the projects that we invest in? So the first thing is geology. The quality of the rocks has to be right. Specifically at the moment, we're looking for things that require a limited amount of capital, because capital is still pretty scarce in the industry. We want significant running room, though, beyond initial resource discovery. And most importantly on this slide is really the point that the assets that we're investing in and despite being pre-cash flow, are significantly de-risked from a technical perspective. So these are assets that already have discovery wells on and are in regions of prolific existing and historic hydrocarbon production. Now, the reason why we focus on geology is to make sure that project economics remain strong. And geology is the key determinant behind high-quality project economics. As you can see on here again, we talk about low capital requirements, fast cycle times, all the things you want to hear when you're putting your money to work in a project. But then this comes on to the point I made right at the start, which is that high-quality project economics have to translate into investment returns for us at the corporate level and therefore for our shareholders. And that means making sure that the entry price is right and that there is a clear pathway to realisation of the value that we create by putting capital into those projects. And part of that is, of course, having an exit strategy in mind. Again, to the point I made earlier, we're not necessarily trying to build production or reserves, we're trying to create investment returns for our shareholders. So just a couple of other specific points related to this, and really about our investment model. So what you'll see when Sachin takes you through the investments we've made to date is that we have taken a slightly different approach than is typical in oil and gas space, in that we have invested into the equity of the operator of the project, as opposed to a traditional farming to become a junior partner within the project. And there's really two reasons for that. Firstly, we feel we get far more control over the direction that the project takes through the shareholder agreements that we've structured with those companies than we would through a typical JOA arrangement. And secondly, it simply minimises cost at the Reabold G&A level. So again, we want every dollar that we can of the money that we raise to go into the ground of the projects that we're investing in. Sachin, you want to take over and talk about the first two projects?
I'll try and make this quick since we've got the graveyard slot here, and I'll try and make it interesting and exciting as well by bringing to life everything Stephen had just said in the examples of the projects that we invested in. So the first one is an investment of £1.5 million to take a 35% stake in a company called Corallian Energy. And Corallian is the operator of the Witch Farm field, which they currently own, the Coulter opportunity, which I'm highlighting just here. Now, to go back to Stephen's points, we're trying to buy into projects which are substantially de-risked from a technical perspective. So why is this de-risked? Coulter has had 4 wells drilled on it by BP, and those wells made discoveries, but they were subsequently not followed up by BP because they had the giant Witch Farm opportunity. And sort of to go back to an earlier question from the previous presentation, why did they walk away from it? Well, you're talking about Witch Farm, which had 480 million barrels associated with it. And at the time, BP had quite a small allocation of resource to Coulter. But you roll the clock forward 20 years, more than that, 30 years I think it is, from when those original wells were drilled, and now you have Witch Farm, which was sold by BP and has 40 million barrels of recoverable resources in it. So when you compare that to Coulter today, which has 30 million barrels and has not been developed, it suddenly looks very, very attractive as a project. We've had the 4 wells drilled on it, the seismic data, and just a richness of information about this area that has allowed us to get comfortable that it is low risk from a technical perspective. Now, our funding of the 1.5 million was important because that's allowed Corallian to get this well drilled in H1 of next year. So it goes to all of the points that Stephen raised originally. A couple of quick other things. We also have to bear in mind the exit for this opportunity. So when we're thinking about ways that this can be monetized, we have to be aware that there is a development plan that is very evident both from a technical and commercial point of view. And since Witch Farm has been in operation, being drilled from the onshore location with 12 kilometers of extended reach wells from that onshore location, to tap the Coulter opportunity from that infrastructure, which is currently completely underutilized, makes way for a very economic development plan, provided we can get terms that both parties can agree on. So all of those things line up, as I say, with the fact that we think we have created, or found an investment that can create value in the way Stephen had described. But there's another thing that I think is quite important, because when you breathe life into one of these companies that has previously been stranded, the richness of opportunities in other parts of the portfolio that we saw existed also start to attract industry interest. So since our investment, we've seen one of Corallian's other assets called WIC, which we have exposure to because we're investing in the company, has received the interest of a farm out from Upland Resources to have a well drilled in the second half of next year. So this investment has allowed us to have 2 key catalyst events next year. One of them, we would like to say, we didn't even have to pay for. Right. I've run through the economics of the Coulter project in principle in terms of how it would work as a development concept. And what I'd just like to draw your attention to here is the commercial chance of success, which has been allocated by Corallian. But this plays to the fact that we've had these wells drilled on this field already. I also wanted to draw your attention to this NPV summary over here, where the NPV break-even is at $18 per barrel of oil equivalent. So when we talk about high-quality assets, the project economics are robust at very, very low oil prices. Clearly, the gearing to the upside is fantastic, but if we get a fraction of the $132 million of NPV, assuming $60 a barrel oil price environment, we will have then achieved what our objective was at the outset of the launch of this strategy. Right, so this morning we announced the second investment, which was a 29% stake in Danube Petroleum, which is currently owned by ADX Energy, which is an Australian company. And in this particular situation, we have this PARTA license, which is located just here, which is in Romania. And the PARTA license had an area called Ichia Mare, where the red coloring is there, which was being produced from by an operator called Amronco. And they were focused only on the oil production. That field has had wells drilled on it that produced gas, but Amronco was not interested in the gas and only the oil. When they relinquished that area called Ichia Mare, it reverted to what is now Danube Petroleum. So our objective on this investment would be to allow Danube, who has 100% of the Ichia Mare, what's called the Carpunish targets, to start pursuing the drilling middle of next year for those opportunities. So what we're buying into here are wells that have been drilled, wells that have flowed gas, and wells that have 3D seismic, again, at what we think are extremely attractive valuations into the corporate Danube Petroleum. So to get an idea of what the NPV economics are here, we have 33 BCF of prospective resource that equates, let's call it, approximately 5 million barrels of oil equivalent, with a low appraisal cost, but still a very high NPV impact associated with it. Now, PARTA is a little bit different to Coulter because this opportunity can be converted into cash flow relatively quickly given the immediate nature of the development associated with it. So we have a sort of balanced portfolio in terms of the nature of options we've created in the success case for Coulter and the success case for Danube Petroleum. I should also say, although we focus just on the near-term drilling, because as we were talking about this 4 wells that Reabold Resources will have exposure to, we are very aware that we need to have that high-impact drilling taking place next year. But we should also stress that there is significant running room in this block with already identified 300 BCF targets and 45 million barrels of oil, 45 million barrels of oil as well. So that's already been identified on the block. but that's something that comes in the next phase and has a slightly longer term burn to it. The advantage of doing the business plan the way we've just described is we would not need to seek, Danube Petroleum would not need to seek further funding to pursue those opportunities. And that's really important when we're trying to close the gap between the value of the asset and the returns that shareholders generate. Right, so hopefully those two examples give you a clear idea of the types of things we're looking at, the types of things we will be looking at in the future. And as a summary, I'll hand over to Steve, who can wrap it up for you.
Yeah, I mean, I think just to summarise really, I mean, in the 7 or so weeks since we closed the fundraising, we've managed to give investors now exposure to 4 high-impact wells next year. We still have considerable dry powder on the balance sheet from the fundraise, and we are continuing to progress a number of additional similar opportunities, so we expect to have more wells than that going down next year.